2008 financial crisis was a major economic event that occurred during the late 2000s.
2008 was a tumultuous year for the economy. The housing market collapse created one financial crisis after another, and it often seemed as if the news could only get worse. Here's a look back at the roller coaster that was our nation's economy in 2008.
It was caused by a combination of factors, including the failure of large financial institutions, a decrease in housing prices, and an increase in foreclosures.
At the heart of the crisis were complex financial products known as mortgage-backed securities. These securities, which were bought and sold by banks and other financial institutions, were based on mortgages given to people to buy homes.
As housing prices began to fall, many people were unable to make their mortgage payments and went into foreclosure. This caused the value of the mortgage-backed securities to decrease, which in turn caused many financial institutions to suffer significant losses.
This led to a chain reaction, with many financial institutions going bankrupt or being forced to be bailed out by the government.
I think this is the most significant financial crisis in the post-war period.
There are fears the sell-off will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
This caused a credit crunch where banks and other lenders were unwilling to lend money, which made it difficult for businesses and individuals to borrow money and make investments.
The crisis had a major impact on the global economy, leading to a severe recession and high unemployment. Many governments and central banks took steps to try to stabilize the economy, such as cutting interest rates and providing financial assistance to struggling institutions.
The economy overcame the impact of the 2008 financial crisis through a combination of government policies, central bank actions, and time. Some of the key ways in which the economy recovered include monetary policy. Central banks around the world, including the Federal Reserve in the United States, lowered interest rates to near zero and implemented quantitative easing programs to provide liquidity to the markets. Fiscal policy. Governments around the world implemented stimulus packages, such as increased government spending and tax cuts, to boost economic growth. Banking sector support. Governments and central banks provided support to the banking sector through various means, such as bailouts, guarantees, and loan programs. Restructuring and cleaning up of balance sheet. Many banks and financial institutions were required to restructure their balance sheets and write off bad assets as a condition for receiving government support. Time. As the economy began to recover, businesses and consumers started to spend again, and the economy began to grow. Housing market recovery. The housing market began to recover as housing prices started to rise and foreclosures decrease. Global cooperation. The global nature of the crisis required international cooperation and coordination among governments and central banks to stabilize the markets and restore confidence in the financial system. It is worth noting that the recovery was not immediate, and it took several years for the economy to fully recover, but the measures taken helped to minimize the damage and prevent a deeper recession.
There are several key lessons that can be learned from the 2008 financial crisis. The importance of regulation. The crisis highlighted the need for stronger regulations to prevent financial institutions from engaging in risky behavior. The need for transparency. The complexity of the mortgage-backed securities at the heart of the crisis made it difficult for investors to understand the risks they were taking on. Greater transparency would have helped to prevent the crisis. The interconnectivity of the global financial system. The crisis demonstrated how events in one country can have a ripple effect on other countries and economies around the world. The role of housing market. The crisis was caused in part by a housing market bubble, which was fueled by lax lending standards and excessive speculation. The crisis serves as a reminder of the importance of maintaining a stable housing market. The importance of risk management. Financial institutions must have the right tools and processes in place to identify, measure, and manage the risks they are taking on. The need for better consumer protection. Many homeowners were given mortgages they couldn't afford, which contributed to the crisis. Stronger consumer protections are needed to prevent such situations from occurring in the future. The role of central banks in times of crisis. The crisis showed that central banks have an important role to play in stabilizing the economy during times of crisis and ensuring the stability of the financial system.